Hi everyone and welcome to my second video of the day. Today is August 20th and no technical analysis on this video. We're just going to show some articles, share some articles, and also go over the last crashes within the last 50 years. The market crashes within the last 50 years. So the reason why I'm doing this is because we're trying to time the bursting of the bubble, right? The Dow Jones has been rallying since we saw the low in 2008. 6,500 was the low, currently trading at 17,100. Okay, so this market has has almost tripled in the last, actually, it has tripled actually in the last 5, 6 years. It's obviously a bubble. The previous high was 14,000. It blew that number away, and the market never looked back. It just continued to go up. So now we're looking for timing. Timing is extremely difficult to predict. All we can do is a bit of prognostication and try to figure out when it is most likely going to happen. So I took the last 50 years and I took the last market crashes that we've had, and I mean, basically, what it looks like is most of these crashes are happening during election year or the year prior to election year. 1962 was an exception. Election year was 1964. We had a market crash back, they called it the Kennedy slide of 1962, also known as the flash crash of 1962. So election year was in 1962, and then you had this market crash back in 2 years prior the election, right? For some reason, we do not see the market turmoil or the runaway inflation and the market crash that we saw back in the late 70s, 1979, 1980. So that crash happened in 1979/1980. So that happened during the election year and the year prior, right? Then we have the next crash, which was 1987. This was obviously the Black Monday. Huge market crash. And of course, election year was 1988. Okay? This one in purple is really the only crash that I found that happened before the election year. This happened after the election year, but again, they call this one a mini crash, right? 1989. Let's fast forward. Let's look at let's look at the year 2000. March 10, 2000, we had a dot-com bubble. This was election year. Collapse of the technology bubble, right? Here we go, United States bear market of 2007. This was a big bear market. The Dow Jones began to slide. This was the year before elections, okay? We had the financial crisis of 2008, 2007, 2008. Very similar to the market crash that we had back in 79, 80, okay? Again, election year and the year before, okay? Then we had this one also. This was also a flash crash. This was back in 2010. That was 2 years before election. Okay, so for the most part, I mean, it seems like these market crashes are usually passed on to the next president. That's what it looks like to me. And if you look at the Dow Jones right now, it just looks like right now the foundation is starting to break. And really, not just the Dow Jones, but really in general, a lot of these indices, most of the stocks around the globe are taking a big hit. And you have countries all over, whether it's China, whether it's Greece, whether it's Puerto Rico, Argentina, Venezuela. I can continue to go on and on. Turkey, okay? I mean, it's just a mess. So again, usually we see a performance in gold when all this starts to happen, and you're seeing a nice rally in gold right now, which you saw on the previous video. If you haven't seen it, check out that video after you see this. Okay, this is another chart that I'd like to show. This is this Dow Jones versus gold, right? This is going to tell you how many ounces of gold you're going to be able to buy with the Dow Jones. So we can see that this is a 200-year Dow gold ratio chart for the first 100 years of the US dollar. We were on a gold standard, the gold standard era. Okay, as you can see, they say that the gold standard is not good for the economy. Blah, blah, blah. It doesn't work. So this is proof right here that the gold standard does create stability, right? So the mandate, the Federal Reserve or the job of Congress is to keep a stable currency. You tell me if establishing the Federal Reserve in 1913, if Congress has been doing a great job, right? This is Dow Jones versus gold. You can see a nice steady uh, trend, right? 1913, immediately after the powers that be take over the monetary system, the chaos that happens, right? So fiat money is mathematically guaranteed to create booms and busts, right? So again, all you have to do is look at a chart because charts can't lie. All right. It looks like to me. So this is back in 1920. This was the peak of the 1920. What is it, 1928, 1929? Just before the Great Depression. You had a peak. Each Dow Jones bought you roughly about 20 ounces of gold, right? By the end of 1930s, then the Dow Jones was only buying you 2 ounces of gold, right? Then by the late 1960s, you had another peak. The Dow Jones was buying roughly 24 to 25 ounces of gold. By the time the late 1970s, early 1980s, by the time we had that next crash, the Dow Jones was only buying less than 2 ounces. It was buying roughly about 1.5, maybe a little bit less, maybe 1 1/3 ounces of gold, right? Then you had another 20-year secular bull market. And by the year 2000, the technology bubble, the Dow Jones was buying you roughly 44 ounces of gold. Okay, now you can see from there, all we've been doing is going down. We've obviously had a decent move to the upside here. Currently, I mean, I think it went up to around 17 or 18 at one point. Right now, we're at roughly around 14. So it does look like it's starting to come back down again. And I'm comparing this move here to this move over here, okay? Huge move to the upside. Maybe at that point people thought that the market was good, everything was dandy, and then that this is what happened. And of course, this is what I'm expecting here. This is a broadening formation. I've shown you guys this formation here before, right? And this is the way these broadening formations usually play out. It's just by nature, these formations are bearish, okay? So even though it might look very unlikely, right? Which I'm pretty sure when we were at 22 to 1, or when we were at 28 to 1, or when we were at 44 to 1, it seemed extremely unlikely that the Dow and gold would ever trade at par. But I think, again, based on this technical formation, it does look like within the next couple of years, maybe 2 years, maybe 3 years, when the metals rally, they rally. So it could be a year, it could be 5 years, it could be 10 years. I don't know, but I do expect within the next coming years, I do expect the Dow Jones to be almost, or if not at par with gold. Now, I don't know if gold is going to go to $17,000, or I don't know if gold is going to meet the Dow Jones halfway, maybe at around 7 or 8 or 9,000 or 10,000. But eventually, I do see gold trading at par with the Dow Jones. Now, if you look at the Dow Jones chart, there is a giant broadening formation in itself, not just this gold ratio chart, right? So that's definitely something to look out for. Okay, let's go to the next one. Right, DAX could revisit 10,000. 10,000. DAX could revisit 10,000 as stock market rout continues. Right. So this is the DAX chart. So Obviously, this is not my chart, so I can't draw any lines. But the stock, the MACD, I don't normally use that indicator, but it's kind of similar to the stochastic. So currently pointing down, nice and hard. There was a nice attempt over here when it got down to 10,000 and a half. We made a big move. It made a big move back up to 11,800, only to be a false move, and now it's heading back down. It's broken plenty of trend lines, broke this trend line here. There's also, if you can imagine a trend line over here, again, I don't have any lines, but if you can imagine a line coming from here, gave this here a bit of support, and that support turned resistance, and now I gave this some resistance, and there you go, the market tanked. So now you do expect 10,000 prices easily. So let's look at the next one. Billionaire Stanley Druckenmiller loads up on gold, makes his largest position for the first time ever. All right. Over the past several years, one of the biggest critics of the Fed's ruinous monetary policy has been billionaire investor Stanley Druckenmiller, who in 2010 announced he would be shutting down his legendary Duquesne Capital Management and convert it to a family office. Yet despite his constant drumbeat of warning that the period of ZIRP, QE, and IPR will end in tears, he had yet to put his money where his mouth was, aside from a brief period in mid-2012 when he bought a lot of gold calls only to unwind them almost instantly. This ended on June 30th when, following Friday's filing by the Duquesne family office, we learned that as of the end of the second half, the largest position for Stanley Druckenmiller was none other than gold, following the purchases of 2.9 million shares of ETF. In other words, as of this moment, gold amounts to over 20% of Druckenmiller's total holdings. That's insane. 20% total holdings in gold. Okay, guys, this just happened a month and a half. This just happened almost 2 months ago. This is this is where the big money is going. If you think that gold is not a safe haven, tell me why would this billionaire put 20% of his holdings in precious metals? We all see it coming. We're afraid to make the move. Don't be afraid to make the move. Follow the smart money. Okay? In a world in which starved for ideas, alpha chasers do anything and everything that billionaires report they did a month and a half ago, we wonder if this marks the end of the relentless liquidation of gold, which recently hit a multi-year low. So again, another good article. You can click on the link below. So let's go through another article. Another great article. Click on the link below, but another great article that tells you this is not sustainable. Remember that home ownership creates jobs. The more homes, the more homeowners there are, the more jobs we create. The more rentals we have, that's no bueno. So let's see what else we have here. Kramer, go for gold. It's portfolio insurance. Now, I don't normally see eye to eye with this guy Kramer, but I do have to agree with this. In light of the market that has dramatic swings from one day to the next, Jim Cramer is teaching investors a new way to diversify their portfolio that will win in any market. After all, the old school method of picking stocks in each sector will no longer protect your portfolio. Instead, Cramer has created 5 buckets of stocks that will shield portfolio while obtaining maximum gain. To begin, every retail investor should have no more than 10 to 15 stocks consisting of high-yielding stocks, growth stocks, speculative and healthy geographical stocks, and gold. Yes, that is right. Gold. Okay, gold brings a special element into a portfolio, one that makes it different from all other metals. However, Kramer warned that this one should not make up 20% of an investor's portfolio. That's way too much. I think that 10% is the upper limit because I consider gold an insurance policy, and no worthwhile insurance policy should be 20% of the money you have invested. Okay? I think during normal times, I think 10%, my opinion is 10% is a bit, you normally want to have in a normal market 8 to 10%. That's the rule of thumb. During inflationary periods or when the economy is not functioning, you expect lower interest rates, you expect higher inflation, and when all these fundamentals come together, the recommended amount is 15 to 20%. Of course, if you follow the big money, right, like billionaire Stanley Druckenmiller, then 20% is what he feels is right. But of course, maybe he has more to protect than we do, right? Billionaire guy here. Okay, Kramer recommends gold because it tends to go up when everything else is going down. Is it the investors' it is the investors' insurance against geopolitical events and uncertainty and inflation. Granted, this may sound like a terrible idea since gold has not done anything spectacular in the last few years. However, just as you wouldn't own a home or a car without insurance, you shouldn't have a portfolio without gold. Okay? Do you get upset when your insurance doesn't go up in value? No, so don't ridicule gold. Okay? Owning gold is not about upside potential, it's about minimizing risk to the downside. Again, another good article, but that's just a rule of thumb. I don't think there's anyone that has been following me knows that you should always have 8 to 10% of your portfolio in precious metals, whether you like it or not. And times of political tension, during times of political turmoil, during times of currency wars like we've been having for the last couple of years, where every country has devalued their currency at to the max, you have to own gold. I don't also agree that you should have 10 or 15 stocks at all time. I think precious metals is something that you should have at all times, no matter what, especially when we are in a fiat system. But again, during times like these, my preferred method would be a small percentage, maybe 20% in stocks and trading, a good big percent, a nice percentage in cash, and again, 15 to 20% in precious metals. Okay, let's go to the next one. This has never happened to gold before. For the first time since record began, hedge funds are net short gold futures according to CFTC. All right, so this is it. Hedge funds net gold position. Short for the first time. Look at that. Look at that little red thing here versus this green. Now, what does this mean? All right. This is what happened last time gold saw a low net long position. This is what happened. A giant bull trend began. Okay. Is this why gold is spiking this afternoon? We don't know. This is about a month old. Actually, about 3 weeks old, this article. Okay. But again, when the sentiment is that strong, chances are that the market is going to go in the opposite direction. So if all these guys are net short, especially all these hedge funds, the hedge funds are always the last ones to get in, always. And these guys, every time they short the crap out of something, it usually goes in the opposite direction. So that's good news for the metals. You have another article here. I like this article, but this is not really an article. I'd like you guys to click on this. This is a video. Watch the video. Kramer invites some technician. This girl, her name is Carly Garner. She seems to be a good technician, and this was actually the Thursday before the market, before gold tanked below 1130, before that key level dip that we saw that brought the metals down to, that brought gold down to 1070. So this was the week before that happened. So this article was back in Thursday, July 16th, and then on Thursday, July 19th, you saw the big move to the downside. But even though she was wrong, and even though the market went down, she never said that it wasn't going down. She said that good support at 1130. I think we all knew that anyway. We've been watching the technicals very closely, and she gives us a very good key pivot points for us to look out for. Okay, it's only about a 5-minute video, so you should click on that if you have a chance. All right, the next, Carl Icahn, extremely worried about stocks, warns it's not if, but when it will happen. Okay, this market has a lot to be concerned about, warns Carl Icahn in an interview, another billionaire. I hope you guys all know this. Click on the link He's just warning everyone that that this is exactly what happened back in 2007, 2008. The media pundits, these guys, they don't care. They're not telling you that there's going to be a crash. They're not telling you to protect yourself. They're saying, hey, stocks are fine. Don't worry about it. And he's just basically warning that there is a giant bubble lurking. And he's actually saying exactly what I've been saying for quite some time. You're going to put your money in the stock market. You're going to hope for another 5% rise, yet you're risking 15, 20, 30%. That's not a good risk to reward ratio. Okay. So there you have it. Those are some articles. Here's another article. Bill Gross says death is coming for him and this bull market, right? Another good article here. Bill Gross, he's been saying that the stock market is no bueno. All right, so another guy. And these are all multi-billionaire fund managers here, okay? So, guys, that's about it. I hope you guys enjoyed the video. It did take me a bit longer to go over than I wanted to, but we have to go over this and pay attention, all right? The Dow Jones taking hit after hit. Key level 17,000. That's key level. You don't want to fall below that, at least not too far. You don't want to have any closes below that either. We'll see what happens tomorrow. Tomorrow's Friday. The Dow Jones has not had a good, I mean, just for the last 2 weeks, it's just been taking beating after beating after beating. We'll continue to keep an eye on this. If I see any crazy moves, I'll do another quick video. But for now, I'll most likely see you guys next week. Thanks for joining me. Enjoy the rest of your night. Bye-bye.